guys, Brian Stevens over here with Mortgage Shots of the National Real Estate Post. Listen, I went and worked out today, and as you probably can guess, I'm not necessarily in the greatest of shape. After all, I'm over 50 years old. What do you expect? I could be a grandfather. Here's my point. My wife asked me, she goes, "How was your workout today?" And I said, maybe a 7 out of 10. Probably a 6 out of 10. Truth be told, yesterday was probably a 5 out of 10, and the day before was probably a 3 out of 10. But you know what it wasn't? It wasn't a 0 out of 10. And here's the thing. With your marketing as a loan officer or real estate agent, if you don't market, put yourself out to your clients, call your best opportunity, which is your past client database, then you're getting zeros across the board. And that ain't good for a salesperson. So listen, if you're marketing, whatever you're thinking of doing, do it. Give it a shot. It's not going to be a negative, but if you don't do anything, all you do is put up goose eggs. Put up some 3s, put up some 5s, put up some 7s, because every now and then you're going to hit that special moment where you actually get somebody to watch what you're doing or listen to what you're messages, and you get a client and you close something. And right now, we have this thing. You're hearing how everything in the market is bad right now. Well, let me tell you this. Right now, according to the St. Louis Federal Reserve, we have 36.8% more sellers than we do buyers. Check out this graph. Again, from the St. Louis Federal Reserve. If we go back to 2020, we had a lot of sellers. That was COVID. Then it fell off a cliff. People quit trying to sell their houses, and everybody complained we have no inventory. Well, listen, suckers, we have inventory right now. It is your job to go get the buyers who are now the hottest commodity in the market. The shifting has already taken place. There's a migration from buyers to sellers, sellers to buyers, and you can influence buyers. Again, 36.8% more sellers than buyers in the market that we have. Now, I want to talk about something right now. If you look at this graph, the median sales price for a home that's sold in the United States has dropped. Okay, we started over on this graph at the end of 2020, and we just saw this massive increase in sales prices, peaking somewhere around mid-2022. But we started to drop off. And if there's one thing I know about graphs, when they go up, they come down. That's basically how it works. Even if we have a long-term trajectory in one direction, we have ebbs and flows where it goes up and down. Right now, my friends, we are going to correct that massive increase in prices that we saw over on our left-hand side. We're going to have more affordability. It's coming back, and we have got the products right now. I got to tell you this. Side note real quick. Have you seen what Angel Oak is doing with their DSCRs? It's crazy. It's actually really cool. And they're the only ones in the industry who's doing this. If you have somebody who wants to buy an investment property, and let's say you're just not exactly sure what that investor is going to use for the rents in order to determine what your ratio is going to be on your rent versus payment schedule, well, Angel Oak in real time is going to give you that rental schedule that they're going to use. So you don't have to order that appraisal, that $1,500, $2,000 appraisal. It's going to take 2 weeks to come back and maybe blow your deal up and piss away a whole bunch of your clients' money. No, the cool thing with Angel Oak is you'll get that up front so you know if your DSCR is going to work. This is massive, and I'll tell you, loan officers, remember trying versus not trying? Take this to your real estate agent partners. Here's what I would do. I would ask them to go out and find any 2-plex, 3-plex, 4-plex, up to, 6 or 7-plex. Find out how long they've been on the market for, because they're sitting, right? And then run that with Angel Oak and see what your DSCR is, and then figure out what the payment would be. Reverse engineer the entire process of selling a house, right? In this place, a multiplex. And if you have a positive DSCR and you know what the payment's going to be, and you've already done your rental survey, which is free and upfront, well, then all you have to do is go out there and find a client. Rather than identifying the property, you identify the client. And how many investors out there would want a positive cash flow, especially with the stock market being up and down right now? I'm telling you, there is money in this strategy. Work it with Angel Oak. If you have any questions about it, do me a favor, reach out to me. Send me a text at this number, or email me, or send me an email at mortgageshots@gmail.com. Now I want to get into the nuts and bolts about what's taking place today. You probably saw, and I've talked about this quite a bit, that Zillow is being sued and they're being accused of RICO violations. This is racketeering, like what the mob does. Now, of the allegations, Zillow is accused of undisclosed and hidden fees, higher interest rates. We know those to be true. Not offering any type of down payment assistance that's available to first-time home buyers, which is kind of common in the area, which of course they're guilty of. And the big one here is steering their clients to Zillow Home Loans. And get this, Zillow Home Loans has increased their revenues by over $1 billion as a result of steering. And they are absolutely doing this. If there has ever been a pay-to-play model, this is it. Why is it considered RICO or racketeering? Well, because this includes you, real estate agents, brokers, loan officers, and of course, their brokers as well. Anybody who's participating by paying Zillow money in their pay-to-play scheme is the reason for the RICO charges. Now, I'm fairly sure this is going to take place, and I've looked at this over the past couple of years when it comes to what Zillow is doing. And what they're going to do is they're going to talk about sandbox laws. Now, in case you're not familiar with sandbox laws, what it does is it gives companies essentially immunity from any type of prosecution should they try something that they deem to be progressive in terms of technology and helping out the consumer. But it gives them immunity from any type of prosecution. And this is from Congress.gov. Policymakers in recent years have considered implementing regulatory sandboxes in financial services. Regulatory sandboxes are frameworks set up by regulators where firms are exempt from legal risk on certain regulations. Now, we talked about this with Open Door and the OfferPats of the world and how they were using these sandbox laws very loosely to go ahead and take advantage of clients. Are they doing this? Well, they're facing a lawsuit right now that's got some pretty serious charges. And if you're in the industry like I am, from a loan officer or a real estate agent's perspective, and you refuse to pay the fees in order to play with Zillow, in order to capture clients and bring them to you, which is a RESPA Reg Z violation very clearly in my book, well, then you know what Zillow has been doing. The sandbox laws in the overview goes on to say, sandboxes are used commonly in a number of industries, but predominantly financial services. This is what we do. Regulatory sandboxes, and by the way, the regulators are going to be all the industries, not just the CFPB. This is the Comptroller of the Currency, the FDIC, the Department of Justice, all of them. Regulatory sandboxes can potentially encourage financial firms to test new technologies or lending methods without any legal risk. This is because particularly consumer-facing financial firms often worry about regulatory burden and uncertain association with novel lending activities. If ever there was a novel lending activity, it certainly is the history that we've seen or the patterns of violation as we perceive them from the industry that Zillow has been guilty of for years and years. After all, they are a for-profit company, and they have a fiduciary, a legal and moral obligation, as I always say, to their shareholders, not to our clients. In fact, it puts them at odds with our clients. Has this been effective? Well, they have been able to grow Zillow Home Loans by over $1 billion when the rest of the industry is shrinking precipitously. Sandboxes are generally offered through the agencies with primary enforcement authority over the laws from which financial institutions are being provided safe harbor. We all know what safe harbor means. That goes back to the good old Dodd-Frank days, where if we meet safe harbor, then we are supposed to be exempt from any type of enforcement or legal action. That's what the sandbox laws provide to financial technology firms in the industry that we occupy. I've got to stress this. This allows companies who are technology first and mortgage second, technology first and real estate second, to run rampant with the rules and the regulations that guide what we do. We are companies that are lenders first, technology second, real estate first, technology second. You have to understand the distinction. Because we are real estate and lending first, we pay close attention to the rules that govern us in our industry. Not to mention, we have a fiduciary to our clients, not to a board or shareholders. That point has to be stressed. Those that do not have a fiduciary to the person getting that loan or buying that house are at odds with them. And when we change laws to make it easier for these technology-first companies to go out there and potentially take advantage of clients for the sake of profit, what do you think they're going to do? Survey says. That's right, and we now have a long, rich history of this type of abuse taking place. In fact, I would venture to say these technology-first firms charge more in terms of rates and fees. One, because they can, and two, their marketing is so good that any potential seller or buyer are not suspecting it. After all, technology fixes everything, doesn't it? But in the case of these fintech firms, it's not making it faster, cheaper, and better. It's just giving them the opportunity to take advantage of the biases that we have about the use of technology, and now we have laws that codify it. Do you think Zillow is going to take advantage of the sandbox laws, which are on the books that you can see right now at Congress.gov, or the CFPB, or the Office of the Comptroller of the Currency, or the FDIC, or the Department of Justice? Do you think, for the sake of profit and fulfilling their fiduciary to their shareholders, that your clients might be unsuspecting victims of what is taking place? Well, there's a lawsuit right now that suggests that's the case, and for one, I sure hope they win this sucker. Let me know what you think in the comments down below. And with that said, I will catch you manana over in the new year. My God, can you believe it's 2026?